It's time for our Muni moment. The Los Angeles Department of Water and Power returns to the municipal market today with a $1 billion offering. This comes about 3 months after the LA wildfires had delayed its previous sale. The utility will use the proceeds to ramp up its capital investment program and refinance some outstanding debt. Dora Lee is Director of Research at Belle Haven Investments, and she joins us now to discuss. So we should get more detail on what demand and pricing of these bonds look like in the next hour or two. But why is this particular muni bond sale seen as a test of how investors price climate risk?
Well, this is a very large issue, and it comes very close on the heels of the Palisades fire. So this is the really first test of the market to gauge investor demand and what, if any, there will be price concessions for the deal. We don't expect there to be price concessions.
Why not?
We do expect very, very strong investor demand, partially because it's in the specialty state in California, so you have the high marginal tax brackets driving investor demand for California paper. But it's also a very large name, and so far, while the credit agencies have put them on negative outlook, there hasn't been large-scale rating movement so far.
Yeah, I just think about the unknowns here for the LA DWP. People don't know whether it played any role in the wildfires through maybe down power lines, and therefore whether they will owe any kind of money in damages. People also don't know what's going to come out of the dozen lawsuits that have been filed against the utility thus far. So all those things kind of add up to some kind of pricing that would go against the utility, you would think, normally. Yeah,
you could think that it does go against the credit, but when you take a step back and look at the market technicals overall, you see the mismatch between supply and demand. I think that's a more important overriding factor on how it's being received in the market.
I see. You mentioned the ratings companies and how they've put the issuer on a negative outlook, meaning the next move could be a downgrade in the credit rating. Does that discourage any investors, or would you need to see an actual downgrade to high yield out of investment grade for that to happen?
I think a large-scale rating movement would definitely move the price of the bonds, but at this point, because there's so much uncertainty, I think investors are deciding for themselves what their target price levels are for the deal and whether or not to participate.
Analysts have pointed out that there's great demand from high net worth individuals for California bonds overall. Why is that? Is it because they are looking at the California market in particular, or is there something else that we're not aware of?
I think it's just the fact that there are so many high net worth individuals in California. We see strong retail demand for California paper, and they're looking for that additional tax exemption from the high marginal tax rates. Okay,
and when it comes to the LADWP, there's a role here that we need to include of the California Wildfire Insurance Fund. It's kind of seen as, the insurance company of last resort in many ways, and whether investors can count on that to at least mitigate some of the costs that the utility might face. How are people thinking about that or talking about that as a factor in the pricing of the bonds?
I think it's definitely a factor. I think investors might be looking at some similar programs in other states. For example, the Florida insurance program that acts as a backstop there for their hurricane risk. But overall, because California itself is such a strong state and is able to supply the finances needed to jumpstart that recovery, that definitely bodes well for the underlying credit strengths overall.
You and I were saying that the utility must really need the money because they had already planned to sell these bonds before the LA wildfires, and now they're coming through with this, even with all this uncertainty. Do you think they're going to tap the muni market again soon?
I think so, given their strategic goals and how they want to change their generation mix and the demand and the capital needs outside of the wildfire. Even before the wildfires, their capital program was quite large, so we do expect them to come back into the market.